So welcome. Oh, could you pass me the clicker, please? I've got a treat for you. Oh yeah, thanks. He just knows what my questions are. He's trying to knock me out before we start. So, as you can see, a great panel. In for a treat, Bob Silk. As no one's seen him before, unless you go to the Springboard pantomime every year. Wow. Bob plays a magnificent dame. We had to stop him dressing like that today, I'm afraid. But Bob does a great job, and those of you who haven't supported Springboard pantomime, please do so. It's worth it just to see Bob dressed as a lady.
Yeah, and I have to tell you, I've got great legs, particularly
He has actually got great legs for a bloke. He really has.
Yeah, definitely.
But I've only seen them on the pantomime, honestly. Seriously. So let's start with the panel questions. So, a question for you all in turn. In today's marketplace, clearly, with so many routes to debt and to the market, who do you find are your biggest competitors, and what are you doing to allay that? So, Emma, first on.
I think the landscape for hotel finance and the options that are available to the UK hotel investor have significantly transformed over recent years.
Yeah.
You know, the availability of liquidity is very relevant in the sector, albeit it's different price points, and I think we see the availability of the liquidity coming in different forms and different structures. So I think for AIB, an advantage that we have is that we're not new to the hotel sector. We've been providing hotel finance for over 40 years. So we have a good track record, and we also have a good established customer base, which is a range of different borrowers, and we've seen a range of different structures and indeed hotel assets. We also have a depth of experience in hotel finance, and obviously that's not a sector or a section of the market that everybody is doing business in. But I think it would be fair to say we have definitely seen an increase in the hotel space from the challenger banks.
Yeah.
And when I say challenger banks,
well done, Ben.
Metro, Shawbrook, and obviously OakNorth as well. But from AIB's perspective, we're not necessarily coming up against them for every single hotel opportunity. And I think where we're sort of focused and always have been focused is the sustainability of the cash flows. Okay. And we're looking at deals very much from a debt to EBITDA multiple rather than the LTV. But an area I think that we have seen a lot of activity and we are coming up against is the institutional investors and the pension funds and the insurance companies. Yeah. But I'm not sure I look at them so much as a competitor, but probably another source of capital that is available to the sponsor. Okay. And I think that probably presents the senior lenders with it does present a different capital structure, and therefore, we're looking at
so not your marketplace, really?
Not so much. I think we'll look at the deals very selectively, and what it does is it really sort of squeezes down the level of senior debt that we can put into the deals. Yeah. But one area, I suppose, where we have seen direct competition would be where we've seen debt funds and actually some European banks taking a view on the London freehold property market.
Which is always a popular market. And I guess the rest of the panel is seeing that. So, Ben, what are you seeing? Who's your competitor apart from everyone?
I think as Emma said, there is a huge amount of liquidity in the market from a whole range of sources. Unlike Emma, we are newer established, and I think that's a great thing because for us we don't have 300 years of kind of heritage which dictates what we do in every transaction. So we can look at things in a very different way. We don't have a legacy book, which means that our view is tainted on particular sectors. We don't focus on particular sectors. In terms of where we see main sources of competition, again, it's very wide-ranging. I think for us, our ability to transact and execute at immense speed is a huge differentiator.
Okay. Shona, what about you? I mean, when I was in banking, it was always institutional investors that would come in and swoop something up. I don't know what you're saying.
I mean, we're not looking to lend to all areas of the market. We have quite a specific strategy for what we want to lend in. I think probably we do a lot of development finance, which is which is a slightly different arena, and actually probably where we're seeing, I mean, everyone said there's a lot of capital that people are trying to deploy, and people are urgently trying to deploy, actually.
Yeah.
We see the debt funds, and probably, I mean, we're still senior lenders and we're still leverage-based. We see some of the competition from the likes of the debt funds or some of the other lenders who are beginning to lend again on an LTV basis. Yeah. And that's one of probably the biggest challenges, because we still believe that hotel lending is cash flow lending with an asset behind it.
It is.
So the LTV point can be quite challenging for senior lenders.
Well, we work with operational businesses, don't we? And that's what a hotel is. Bob, you must have seen plenty going on, as I did.
So, who have I been up against recently? Up against
You've got to forgive my friend. He'll always do a twist on everything.
So I've been up against RBS twice and won. Been up against Santander and lost badly, which was a shame. Been up against Bank of China and they won, but if you want to do 15 times EBITDA, even on a London hotel, I mean, you're welcome to it. I don't want to compete in that area, and even if I did want to, Barclays Bank isn't going to go there. And I recently lost a pub customer to Metro, and I've got to be frank, I didn't shed too many tears about that, to be honest with you. So there's no one single competitor that my colleagues and I have encountered. It's all over the place. There's just an incredible amount of liquidity around.
That's the truth, isn't it? It is. So Ben, a challenger bank. How does that work for you, and how do you compete against the larger banks like Barclays, Lloyds, Clydesdale, AIB? How do you benchmark yourself against those? I know you briefly talked about the fact that you're fleet of foot, but perhaps you can just let us know how you do that.
Yeah, I mean, look, we certainly don't and can't compete on price. We don't have the source of funds, the cost of funds that the bigger banks have. So we're definitely reassuringly more expensive.
So what is your differentiator then, if you're reassuringly more expensive?
Again, so speed is a big thing for us. Yeah. Flexibility. So, whilst leverage is important, for us it's one measure. And I think, looking at loan to value, not in isolation, but as another measure in certain key markets like London is good and fine. And looking at alternative use value and bricks and mortar value, again in certain markets, is good. So flexibility, and I think the biggest differentiator, certainly in my career, that I found is our openness and transparency in terms of bringing our borrowers into our credit process. Okay. So I think we would all agree that every entrepreneur has been frustrated by a credit process in a bank.
So you bring your credit guy out the cupboard?
Well, we don't. No, we bring our borrower into our physical credit committee.
Oh wow!
So this isn't a credit partner model or a credit guy that then is kind of removed from the process. We bring our borrowers physically into the dragon's den.
It's enough to scare them to death.
Yeah,
isn't it?
Some borrowers see it as a bit of a challenge to perform. Yeah. We haven't had any borrowers dress like Bob did.
I'm sure Bob could arrange that.
I could submit a loan application to you if you like.
And what that does is quite simply, it means that we've executed on deals that, based on paper alone, we would have walked away from.
Okay.
And we've walked away from deals that, based on paper, we would have done.
Okay.
And our borrowers like that transparency. They like meeting the real decision makers, and that's worked very well for us.
I don't think you can underestimate, though, the face-to-face with the borrower and the management team, specifically in hotels as well. It's so important. So for credit to eyeball, what we see as on the front line is really important.
I think so too.
That transferring that experience capability in person is a lot easier than on paper.
Yeah. What do you think?
Yeah, I mean, I suppose, we don't bring our borrowers into credit committee, and, we sort of, take that sort of role on ourselves to be able to sort of transfer, the type of strength and, skilled management team that we're working with. Yeah. And I think, I go back to the fact that we're not new to the sector and the fact that it's a growth sector for us. So we have our back of office and credit teams aligned with what we're trying to achieve on the front line.
Okay.
So the fact that we're looking to grow the book, requires the entire business to be behind us.
Yeah.
And I think that's the sort of process that we have at the moment.
Okay, so if OakNorth have this slimline approach and bringing in their clients to meet their credit team, so it's seen as a one-stop shop, how do you compete against something like that, Bob?
That's quite challenging.
Yeah.
We don't bring customers in to meet credit committee.
No.
That's a completely divorced process, albeit, on occasion we take credit out to see a customer because there's no, to Shona's point, there's no substitute to eyeballing someone and going around and kicking the tires of an asset and so on and so forth. I guess that OakNorth and other challenger banks, because they're so much smaller organisations, inevitably it enables them to be much more fleet of foot. If you're sailing a racing yacht, you can turn around on a sixpence. If you're at sea in a large oil tanker, it takes a while to manoeuvre around the ocean.
Yeah,
and that's just a fact of life.
I love your analogies, though, Bob.
So do I, thank you. That's not to say that, one of the big traditional clearers cannot be fleet of foot.
Yeah.
And, the devil's always in the detail. I've got a pub customer, they've got a committed facility. If the FD phones me up today and says I need to draw tomorrow, it's the work of a moment, we'll draw tomorrow and fund a transaction.
Yeah.
If you walk off the street and you say, I want 10 million quid in 7 days, bluntly, that's not going to happen.
No.
Because we live in a compliance-rich world, and even though you could get in and out of credit maybe in 7 days, you're not going to get all the compliance
You're not allowed
stuff
to go on
sorted out.
about compliance, though.
Am I not?
Today. No.
Taboo subject, sorry about that.
We could be here a very long time.
Yeah, so,
So I guess
the
you
larger
can be
banks have the ability to be fleet of foot. I mean,
Yeah.
just recently, I was in and out of credit in 7 days with a full credit approval to lend 80 million quid on the refurbishment of a 5-star hotel in London. So that's pretty fleet of foot. It's going to take a darn sight longer to document it because it's a really complicated structure and there's lots of legals around it.
Yeah.
So, banks aren't always quite as clunky as they at first appear.
No, I know, that's the truth. So, looking at how do you become a differentiator in this mad world of lots of liquidity, Clydesdale and AIB are happy or appear to be happy to put their foot into the development world. Is that the case?
Yeah, I mean, we have been actively looking at development finance for the last 4 years when there were very few banks in the market. It was the end of the great financial crisis. Liquidity was very, very tight.
Yeah.
I joined Clydesdale with the remit to grow our business. We were a relatively small team, which, going back to the previous question, made us quite fleet of foot.
Yeah.
But, we have a slightly different capital base to the likes of Barclays and some of the big teams. So we like risk because we get the return for that.
Right.
So we were very happy to move into that development space. My background was in development finance. In fact, Emma and I had done a lot of development finance together previously. And we understand it, and we like building hotels. So as long as you are prepared to take a bit of a project view on a hotel, you are flexible during the development process, and you understand. I mean, for example, we're quite unusual as a bank. We will go to every single monthly site visit for our developments, of which we have several. So Dan, who looks after, he's all over the place in Bath, Edinburgh, Manchester, all over. So probably, look, we've evolved a little bit in the last 4 years, so we do much more traditional refinancing of trading businesses, etc. But probably we were the only bank who came out and said, development finance is what we want to do. We continue to be like that.
Yeah.
And probably 80% of what we do is still development finance, which makes us quite unusual.
Yes.
It is becoming more competitive, though. The debt funds are coming in,
It's a tough world in finance.
It
It
is.
really is. Yeah.
It is.
You should change your name to Bob the Builder.
Well, exactly.
I want a photograph of it for next year with the hard hat on. So Emma,
Yeah, I mean, we are looking at development, but we have a much more balanced portfolio review. So it's not so much that we're doing 80% of development. We're having a much more sort of balanced approach to that. And I think it goes back to pre-financial crisis. We would have been involved in a number of different significant hotel development transactions. Yeah. So I'd say it's fair to say that we definitely did pull back from that initially. But because we had that knowledge and understanding, and again, as Shona's referred to, it's a different risk profile, and it's a risk profile we're prepared to take, albeit there has to be a balance overall in the book. And for us, I think, it's location, but it's also about the sponsor, and the depth of, pocket or equity to be able to deal with a situation which we haven't foreseen.
Yes.
So it's a much deeper sort of review that we do. But yes, it's an area that we've appetite to grow our book in.
Oh, good. Yeah. So a couple of differentiators there, but what is your differentiator?
Okay. So who here has had an extension done on their house? Show of hands. Yeah. Was it on time?
No.
Was it on budget?
No.
His was.
No.
Gentleman in the first row.
Yours was on time and on budget.
You're the exception rather than the norm. This is the difficulty with development funding. It always goes wrong. Or it invariably goes wrong.
It doesn't always go wrong.
It invariably goes wrong.
We've got a number of cases of on time, on budget. We've also had contractors go bust.
Really?
Yeah.
It needs monitoring.
It's not what happens,
it
it's
needs
how you
monitoring.
deal with it.
In that case, I've just been damned unlucky because my experience is it invariably goes wrong. And it's a headache. So we are very, very
So Bob's
selective
differentiator is it always
about
goes
what
wrong.
we will do.
He's
So I'm
unlucky.
finished.
on.
Barclays is very selective about what it will do in development funding. So we've done some, and we've done some really substantial and quite prestigious projects. But we're quite picky and choosy about it. So we don't want to, as it were, unbalance our book with an awful lot of development funding, which is very, very labour intensive, and for us difficult to earn the right kind of return on it.
Thank you, Bob. Have you finished?
I'll shut up now.
Thank you. So Ben, given so many routes to market in terms of debt, why OakNorth? Why would people go to OakNorth?
Look, we've lent £2 billion in 3 years now. So clearly there is demand. Clearly there is a need. As I said earlier, I think our speed, flexibility, and transparency have been the key to that growth.
How do you get that message out, though? Because every bank says the right things at the right time to the right people, but
that's the
how
challenge.
do you get that out?
That's the challenge, and when I started, I was on my own, and now there's 15 in the origination team.
Oh, wow. So quite a rapid growth.
Yeah, and when you're dealing with some high-profile clients, they tell their friends, and we've got a great PR function that constantly tells the world what we're doing. But there's nothing like a good example of a good transaction to educate people on what we're doing.
So ladies, a question to you both. Do you think sometimes Clydesdale and AIB can be seen as a bit of a challenger bank?
Well, I mean, we should be. There's only one non-challenger up here, and that's Bob. There's only 6 non-challenger banks. So Clydesdale and AIB definitely should be considered. We probably, at Clydesdale, we fall more into that medium-sized full-service bank challenger. I know our CEO is definitely convinced we are a challenger. We're probably a bit bigger than, some others, but we definitely view ourselves as a challenger bank. And actually, sometimes as a challenger bank, the measure of our success is not necessarily how we compete with Bob and Barclays, but actually we target specific segments of the SME market: hotels, real estate, housing associations, healthcare, growth finance, all sorts. And actually the measure of our success is how we cater for the clients that we are focusing on, not actually whether or not I win a deal against Bob. It's have I met my specific strategic goals. So we definitely view ourselves that we're more fleet of foot, probably because we're a bit smaller. We can't probably do credit in start to finish in 3 weeks. But we have done a complex transaction in 6, which was development, a trading asset, had mezzanine in, offshore, nominee companies at Christmas. we did all that in 6 weeks. So we can move.
Yeah,
we can move
of
quickly
course.
as well.
But I think most banks can move fleet of foot.
Yeah.
If they need to,
Yeah.
for the right deal, you would
Yeah.
push out all stops. So Emma, how do you feel about that?
Yeah, I mean, by default, we are a challenger bank, but AIB in Britain has been very clear, particularly in the last few years, about where it's putting its balance sheet.
Yeah.
So we have a very sector-driven approach, and it's not just hotels. There's a number of other key sectors in which we are focused in on. And I think, a bit like what Shona has said, we've found our place in the market,
Yeah.
the place that we're comfortable in, that we have good experience and good track record in, and we're focusing in on that. Earlier this year, we launched a number of different funds, and one was for £500 million in the hotel sector, and that is us allocating balance sheet to grow our book there. So we are very much focused on what we do well, what we've done well, and what we've got track record in. But yeah, I think by default we would be a challenger bank, but we like to consider ourselves experienced in those particular areas.
Great. So challenger banks, are you often seen as a last-stop shop? Ben?
I think that's probably slightly unfair. I think we are a fully regulated bank by the same guys that regulate the rest of the banks here. Getting that banking licence clearly isn't easy. We were the third new bank in over 150 years in the UK. And we're definitely not one of these alt-fire companies or peer-to-peer lending platforms. And again, we've lent £2 billion in 3 years across multiple sectors to some phenomenal clients.
Yeah.
Now, often our clients say to us, we are choosing not to work with the mainstreams, as opposed to them choosing not to work with us.
Yes. Yeah, I can see that. It wasn't an unfair question. I just wanted you to give the answer. So I guess it's, just letting people know that although you're a challenger bank, you are not a one-stop shop. You are, you are out there trying to get in good quality business and to push this OakNorth further.
Yep.
So from our perspective, I just wanted you to be able to say how good you really are, Ben, just in case I start throwing tomatoes at me before I finish.
So from a borrower's perspective, how do they see a challenger bank? And what I'm about to say is not in any way, shape or form directed at OakNorth, so there's no need to take me outside and give me a slap later. But
I might.
I'll look
Come
forward
on,
to that.
Bob.
That'd be good. In fact, yes, please. So I think from a borrower's perspective...
He's a hopeless case. He really is. I don't know why he's on the panel, actually.
No, I don't know what I'm doing here either, but I'm just making it up as I go along. But I think borrowers, or a borrower, will find in a challenger bank, and certainly a debt fund, a path of lesser resistance. Yeah, and we're all human beings, and we all like to take the path of less resistance. And the path of less resistance in this context is often that, particularly a debt fund, maybe some of the challenger banks, will put more money on the table. And I've come up against a few situations, particularly in the restaurant sector, where I've seen debt funds extend the most eye-watering sums of money to businesses. In the restaurant sector, 6 terms of EBITDA, which quite frankly is insane. And I had conversation with management saying, okay, well, you can take this if you want to, okay, and it comes at a price, because they'll charge 8 or 9%, so it's really like mezzanine funding. It's certainly not senior debt. But be careful what you wish for if you're going to fill your boots with that much debt. And some of the, particularly the debt funds, are very, very aggressive. And you ladle that much debt into your business, it's a little bit like you eat too much sweeties and you rot your teeth. You take too much debt and you bust your business. It's that simple. So you've got to be careful what you wish for.
Yeah. Yeah. So, thank you, Bob.
Always a pleasure, never a chore.
It's not Tuesday,
So,
Bob.
Ben's talked
It's not Tuesday.
Ben's talked a little about the OakNorth credit procedure and how they're a fleet of foot. Over the years, and I was a banker for 44 and a half years, so, we always were criticised for clunky credit. So how do you dispel the myth of clunky credit, and how do you get people on board to understand what the process is? So I'm not going to you first, Bob, because you'll go on. Emma.
I'll keep it short. Yeah, I think it's like anything. For an existing customer that we know well, we're going to be able to move very quickly because we've got a depth of knowledge on them. But, somebody new coming to us looking for a loan facility doesn't necessarily take an age. Without the sound of repeating myself too much, because we know the sector and we know what parameters we've got, we know the type of deals we're going to do and we know the type of deals we're not going to do. So I think we will be very quick with a no if it's going to be a no. And if it's going to be a yes, we'll be very clear on what we can deliver and how. We have a credit committee that sits 3 times a week, and if we want them to sit 4 times, they will.
Okay.
So there's a nimble approach. We're small enough to be able to, in fact, the building that I sit in, credits sit on the floor above.
Yeah.
So it's a matter of going up and having a conversation sometimes. So whilst we probably couldn't deliver 20 million and draw it down within 2 weeks, it really depends on the deal, and if needs be, we can put a team and put a resource on something to turn something around really quickly.
Okay.
Yeah.
So, Shona, I guess communication's always the key, isn't it, when you're doing a transaction?
Yeah, I think so. Look, for us, we don't necessarily get through the door as first because we're not Barclays or Lloyds or RBS. So probably for us, deliverability is one of the most important things. People want to know that we can deliver on what we say we're going to do. So we do take credit out to customers, and some of them come and sit on our site visits and all sorts, to give them that sense of our customers. But actually, it's what we do to give confidence to our customer base and our borrowers is that we will get very quickly, usually within a week of a first meeting, it can be as quick as that, we'll have your pricing locked in, and also we'll have a first stage credit support, which allows us to put out terms that are actually, have been endorsed by our credit team. Your pricing is absolutely locked in, which gives people confidence as we move forward to credit, because it's really important. No one wants a last minute issue.
Well, no one wants a last-minute no, actually.
Well, exactly.
And that's the biggest issue.
Exactly, and it comes back, to what Emma was saying about as well, knowing your market, knowing who you want to, as a bank and a challenger bank, who is it that you want to bank?
Yeah.
What's your target market? And understanding our credit appetite within that.
Yeah.
And that's what we've been very successful on delivering on the terms. And I think that's what most borrowers want, actually.
Yeah. Bob? Do you want to add anything to that, Bob?
Yeah, we have a healthy tension with our credit committee. I think that's fair. So we have some quite spirited debates. But once we say we're going to do something, even at an early stage of credit approval, we'll put out, outline terms. We will deliver on that. So, you hear war stories about some banks putting out terms and then deciding they don't want to do it after all. We will not do that. We will deliver. But we do have a spirited debate. I have to tell you, if you've got time for an interesting little anecdote. I recently had a very spirited exchange with one of my colleagues.
You've only got 12 minutes, Bob.
Okay, spirited exchange with one of my colleagues in credit, and he sent me an email saying, Bob, judging by the tone of your email, he said, I think you've become somewhat emotionally attached to this customer. So I wrote back and said, bloody hell, I'm not even emotionally attached to the wife, let alone the customers. But anyway, we got to the end of this debate, and the fella turned around to me and he said, I really don't like this. He said, but I'll tell you what, if you want to have a punt, you can do this. And I was absolutely staggered. I asked him what he was smoking. It was really quite... So you get there in the end.
So, Ben, clearly you're more fleet of foot. So how's your credit process, and how do you engage with your clients going forward?
So all of our clients come to our credit committee, as I said.
And that's just mandatory across all of your debt deals?
Yeah.
Oh, okay.
Yeah.
What if they don't want to come?
Don't borrow the money.
Why wouldn't a borrower, it's a good question, but why wouldn't a borrower want to sit in front of decision makers of a bank? Why wouldn't the borrowers want to meet the CEO of a bank? The last time I checked, most entrepreneurs want to talk about their business. In fact, they don't want to do anything other than that. And if you kind of wind them up at the back, they go forever.
Exactly. And I guess you say you are an entrepreneurial bank for entrepreneurs.
Yeah.
So.
And look, that's another great differentiator for us,
Mm-hmm.
because the two founders of the bank who are fully involved, one of them sits on every single credit committee, are not bankers. They are world-class entrepreneurs that have scaled and sold
Bit of a dragon's
businesses.
den, then.
Yeah, look, by title maybe. I mean, it's, you know, there's no stand-up presentation and you know.
Oh, is it not?
There's no you're fired and there's no none of that.
Yeah, but it sounds, you know, like they get a good punt at putting a transaction through.
Yep.
Yeah, that's great. Have
It's
to try that,
interesting,
Bob.
Yeah, at Metro Bank, if you want to borrow more than £5 million, you will end up sitting in front of Vernon Hill, the founder.
And the dog.
And his dog.
Yes,
And his dog.
Yeah, and his dog.
Yeah,
Doesn't go anywhere without the dog.
so I understand. And I know someone who went and had a meeting with Mr. Hill, and I'd gone through the whole credit approval process, but I think the meeting was a bit like the immovable object hitting the unstoppable force or whatever it was, but they fell out and they didn't do business after all.
So, a little question for the three mainstreams, and not you, Ben, at the moment,
Would
but
you
you might
mainstream?
want to join in because you have been a lender for a very long time, so this is not a new job for you, is it?
No.
But, so we've all had to, in the past, weather the economic storms. What are we doing to dispel the myth now? Because it's taken a long time for people to, I wouldn't even say you like banks yet, but for you to get over what's happened in the last 10 years. Bob, what have you done to dispel it, other than dress up as a woman and sing?
Yeah, but that's only at the weekend. So it's interesting, isn't it? I guess when I or we say yes, we're everyone's best mate, and when we say no, we're their worst enemy. And on a good day when the sun shines, I'm probably only about one step removed from an estate agent, let's to be honest about it. Our approach with our customers is as collegiate as we can possibly make it. So if I lend you money, and for me that's a very personal thing, it's I'm lending you money. We will do our best to stick together, you and I, through thick and thin, good times and bad. And when things aren't going quite according to plan, we will do our best to wrap as much resource around your business to try and help you turn it round as quickly as you can. So we don't consider ourselves to be a fair weather lender, which is somewhat different to what certainly Barclays and all banks were really in the 90s recession. I mean, there was, you know, a significant amount of pain going around as banks withdrew the umbrella just as it started to rain. So we've learnt a lot of lessons and we have a lot of remembered pain about that. And so as a consequence of that, in terms of our lending policies, some banks' lending policies, particularly I think overseas banks that come into the market, they're sort of in and out and they ebb and flow, and their lending policy or their approach sort of goes up and down a bit like a yo-yo. I can only speak with authority for Barclays. Our sort of lending appetite, it does that as opposed to doing that.
Yeah.
And that's because we've taken care to be a lender throughout the cycle, in good times and bad.
So Shona, you're a nicer banker now than you were 10 years ago.
Well, I don't know about that. I'm older, unfortunately. I think, look, through the cycle, we all saw what happened, and I think I hope we're in a slightly different market, and we certainly lend in a very different way. You know, it does worry me what I was talking about earlier about those who are LTV-led, you know, and Bob was saying the more money on the table, you know, when things get tighter, you know, and things start going wrong, are you with the right institution who's going to support you? Understand a hotel needs to stay open, needs to trade. It's a trading business. I mean, we go back to, you know, and I go back to almost where I started in terms of being a cash flow business and a leverage lend. We look at it on the basis of debt to EBITDA. With LTV is secondary, really, because actually how do you service your debt? How do you cover your interest? That's what's really important. How do we lend now? We do some very robust sensitivity analysis. We go to our friends at the valuers and ask them, where did yields go? Where did GOPAR go in the downturn? What was the low?
Yeah.
And we'll take our, particularly development funding, we do an awful lot of forecast-led lending, so we don't even have the benefit of, you know, the last 3 years of trading. So we will do some very robust sensitivity analysis and we'll break it.
Yeah.
And inevitably, there is the headroom. And actually, we insist with our borrowers that we lend with sufficient covenant headroom as well. because no one wants to open a hotel and 3 months down the line have a covenant breach.
Yeah, I know.
So I think that as where we are in the cycle, we have to be responsible lenders. It's not, there is a lot of competition and a lot of competition on an LTV basis. I think as a mainstream lender, as you called us, Diane, we have to remember what's happened through the cycle. And as Bob said, not just be fair weather, be prepared to support our clients, which we are in the downturn.
That's good. Before I come to Emma, Ben, I mean, you've lent money for many, many years and recently gone to OakNorth. What would, how's OakNorth preparing its clients and itself, indeed, if there is another economic downturn? So is that a very relevant part of your job? Are you looking at that?
Yeah, massively. So, we've not lent through a cycle yet, which is the very obvious point.
Yeah.
We haven't had any issues across the deals we've done to date, which is great. But there's nothing new about my experience, about the guys in the team's experience, about our credit guys' experience. These are all experienced bankers that have been through multiple cycles. Lots of our clients have been through multiple cycles. I think the reality is that with the combined experience we have from multiple banks, we've taken some very good bits from other institutions and wrapped them into a model. So, for example, one of the things that we don't do is purely rely on our professional panel.
Yes.
Professional advisors. We have a lot of that in-house. We have a valuer in-house, we have a QS in-house, we have a building surveyor in-house. So, it's great for one of my team to go to a site meeting and walk around a hotel and, think they're a builder for the day with their hard hat.
Yeah.
The reality is we've all collectively done that many times.
Yeah.
Ultimately, we don't really know what we're looking at. We've got a project manager in-house that's all he does every day. He's on the road every day, turning up randomly at sites, what's going on. So we've built a team and we've built an approach that very much encompasses the good bits from a lot of different.
And I
lenders.
wanted you to get that point out. OakNorth might be a new bank, but the people in
There's
it
nothing new behind what we do.
are very experienced from other organisations. So Emma, sorry, I just wanted Ben
that's
to be able
okay.
to get his point over.
No, I think the panel have covered quite a few points, but from AIB's perspective, there are lessons learned through the last financial crisis and the other recessions, and we've been a through the cycle lender. So we've taken, some very valuable lessons, and the way we look at a transaction now could be slightly different. There's a lot of robust internal financial modelling that goes on. We take the experiences, we apply our growth assumptions. Equally, we apply sensitivities that are based on, what happened in the last recession. Where did RevPAR go? Where did GOPPAR go? And they're the type of sensitivities we apply. So, we come up with a bank base case that we're comfortable will weather the cycle.
Yep.
And in that case, the level of debt that we're putting on is based on that. So we feel comfortable that we're being sensible and we're being, responsible lenders. And very much what Bob said, we want to, if there is, issues in the future, we are relationship driven. We want to work with our borrower. It's in both our interests to get a good outcome.
Yeah.
And that's pretty much our approach,
But Emma, you say you've learned valuable lessons, which a lot of the banks have. Do you think some of those lessons, do you think people are starting to forget with some of the things that we see in the market,
based
some
on
of the leverage and
it goes back to that LTV play, and based on some of the eye-watering terms that I've been shown by some of my borrowers saying, well, I can get this elsewhere, and it is quite scary. But we're not going down that route, and we will continue to focus on the cash flows and sustainability and those sort of sensitivities. So I think as long as we stay grounded in that, and we intend to, we think we will weather the next recession much better. And
I mean, great. I mean, for me, as an ex-banker...
It's a very pertinent point.
It is.
Because where money is concerned, people generally are greedy and they have very short memories. Fact.
Is that it, Bob? Before you get thrown off the
that's the
stage.
profound
Profoundly, that's right.
But also, our borrowers have been through the cycle, and we have some very sensible borrowers out there that are very protective of what they've built up and what they've grown.
Yeah.
So whilst we do see some scary things going on, some of these hoteliers that have owned, these assets for a very long time, they get it, and they're not asking for too much. I think there's
It's
different
not all
pockets
about
of,
leverage, is it?
It's not all about leverage, and actually, there are some borrowers who want to repay you. They don't all want interest only.
No, that's fatal, repaying a debt.
Yes.
So we're running short of time. I just quickly, for those people who are in the service department sector, growing sector, no longer an alternative. So are you guys lending to that sector?
Yes, we're very interested in that sector. We see, the future of the hotel market is certainly changing, and what people want out of a hotel experience is definitely evolving and changing. I suppose the margins that you can get on these type of transactions are very attractive.
Yeah.
So yes, we are looking at it,
Good.
and we're open to looking at those type of deals.
Perfect, Ben.
Yeah, we've done those sorts of deals. We financed the development of the Stay City building in Liverpool.
Oh, fantastic.
So we're definitely in that
Great.
market.
Shona, you into that?
Yeah, no, very interested in that. It's just another part of we see it just another part of the hotel sector and
We
how
understand
it's
it
evolving.
so much more now, don't we? That's
how
the
it's evolving
difference.
and co-living, and that stretches into all. It's just another form of hospitality.
Okay.
We've not done any, would we? Yes.
Oh, brilliant. Okay, well, guys, we're running out of time. We're on our last 20-second countdown. Are there any questions from the audience for the panel? All trick ones go to Bob Silk. You have remembered that, haven't you? So here's a question from an anonymous. There is small solid operators that are growing within their capacity. Do you have advice on who best to seek growth money from, as all too often cash is tight? Ben, do you want to have a go at that one?
Yeah, sorry, I didn't catch it. Can I read
I say
it?
there is small solid operators that are growing within their capacity. Do you have advice as to who best to seek growth money from, as all too often cash is tight?
Yeah, I mean, look, if you're growing within your capacity, then great. Clearly, none of us are here to allow businesses to grow not within their capacity. I suppose what I would say is, if it's a debt proposition, then by all means, come and have a chat with us. If it's not a debt proposition, then I'm sure all of us here can signpost you to alternative sources of capital across the whole stack.
Yeah. Anything else from you guys? No? Okay. Brilliant. Thanks, Ben. So here's another one. In today's uncertain financial markets, should borrower sponsors use alternative financing methods to spread risk rather than relying upon relationship banking? Bob, do you want to have a go at that? I told you were getting the trick questions.
Depends if you regard debt as a commodity or not. Yeah. So there's a lot of liquidity around. In the great scheme of things, you can get it anywhere at a price. And you can, with relative ease, fill your boots because it's a commodity, which is fine when you're in a relatively benign environment. But when the cycle turns, that's actually when you need to have a solid relationship underpinning your capital structure, or relationships underpinning your capital structure, rather than a set of commodity providers.
Yeah.
Because commodity providers will probably seek to take their ball back really, really fast.
Okay.
And at the time when you need most support and most understanding, that's when you need a relationship underpinning it.
I agree entirely, and I think all of the team here on the panel would agree that. So very quickly, because we're really running out of time, how do you all differentiate your pricing margins? Just very quickly.
Well, I think probably we all operate on a risk-based
Yeah.
approach. There's no, none of us, I don't think, operate on this price for this sector. Everything is individually priced and risk assessed.
Ben, same for
Yeah,
you guys?
same, yeah.
So no change there. That's our final questions, unless there's anything on the floor that people are desperate to ask. However, I'd love to thank my panel. I think they've been great. Can we give them a round of applause?